The microeconomic impact of rising oil prices. A rise in oil prices will cause a fall in demand. However, because oil doesn't have many close substitutes, demand will be inelastic, and we will see a smaller percentage fall in demand. The elasticity of demand for oil in the short run is estimated at minus 0.05, which means a 10% rise in oil prices reduces demand by only 0.05%. Secondly, higher oil prices will lead to a rise in the cost of production for many goods where oil is an important component of a supply. We will see a rise in the price of fertilizers, which is a byproduct of oil refining. Higher oil prices will also tend to increase food prices. This is because more expensive oil will raise transport costs, increase the cost of fertilizer, and also will be higher energy bills for food products like cucumbers and tomatoes, which might need extra heat. Thirdly, with higher oil prices, there will be a fall in demand for complementary goods like, say, petrol cars. Now, this effect will be greater now that electric cars are a more realistic alternative to petrol cars. However, if the rise in the price of oil is sustained, then we will also see a rise in demand for substitutes for oil-based products. For example, in the long term, with higher oil prices, you would expect more demand for organic fertilizer and more demand for electric cars. In the short term, demand for oil is very inelastic. But over time, in the long term, demand will become more elastic because sustained higher oil prices will encourage consumers to diversify their consumption. E.g., there's a greater incentive to buy electric-powered cars, fit solar panels, or buy organic fertilizer. Therefore, in the long run, demand will start to fall by more than the initial very inelastic reaction. The long-term elasticity of demand for oil has been estimated at between minus 0.23 and minus 0.83, which means that a 10% rise in oil prices could reduce demand in the long term by 8.3%. Now, after the oil price shock of the 1970s, manufacturers started to change their approach. US car manufacturers paid more attention to the fuel efficiency of their engines. It also created an incentive to develop electric cars. And in recent years, the growth of electric cars has really given consumers more alternatives. This shows the declining energy intensity of global GDP. It shows that oil is less important than in the past, so demand will be more price elastic, more sensitive to rising prices than in the past. Also, another thing about higher prices is that they act as a signal to producers that this is a profitable business, and if the rise is sustained, it will encourage firms to try and find more oil supply, even if it's perhaps a bit expensive. So after the oil price shock of the 1970s, there was a new wave of countries who began producing oil in countries such as Venezuela, Russia, and remote places like the Arctic. Even though costs of producing oil are high there, with higher prices, it becomes profitable. But it is worth bearing in mind that supply is very inelastic in the short term. It can take many years to discover and start to drill and then get it to the market. Firms will want to see oil prices rise for a sustained period. Now, this diagram shows that in the short term, higher oil prices cause price to rise to P2. But in the long term, supply is going to increase again to supply LR, and also over time, demand falls to D2. Therefore, the final equilibrium is with a price of P3, so it's an element that oil markets will be self-correcting in the long term. And this is an example of prices signaling shortages, and eventually the market adjusts, but with oil, there may well be considerable time delays. This graph shows the inflation-adjusted price of oil. The big rise in oil prices did cause greater supply, but also demand for oil was moderated. Do check out this video on the macroeconomic impact of higher oil prices.